Order blocks are areas in trading that present interesting opportunities. But have you ever wondered why some order blocks are successful while others are overlooked by the market? To address this question, we analyze the key characteristics of effective order blocks in various market conditions that gain recognition from traders. We have implemented several rules to assess their impact on the success rate of order blocks and have gathered interesting findings. Our conclusions indicate that order blocks perform well under specific circumstances when certain repetitive patterns emerge in the market. In this video, we will first outline the fundamental rules in a straightforward trading setups for dealing with order blocks. Next, we will elaborate on the prerequisites for high probability order blocks and strategies to enhance their success rate. If you find this topic interesting, please consider liking our videos to show your support and subscribe to our channel for more content on advanced trading concepts and cutting edge technologies. Let me break down some fundamental rules about order blocks in smart money concepts. To simplify, we pinpoint the last candle that caused an inefficiency as the order block zone. We think that crucial decisions are made during this specific candle. Let's delve into the dynamics of order blocks. They can pop up either at the beginning of a strong move or somewhere in the middle, appearing as a candle with either the same or opposite color. To spot a valid order block, we stick to three key rules. Rule number one, it has to create inefficiency. This happens when we witness significant moves that lead to noticeable gaps between the candles. Now let's take a look at examples of both efficient and inefficient moves. Rule number two, it should result in a break of structure or a change of character. This is crucial because such a break or change gives us the initial hint about whether the market plans to persist in the current direction or reverse. Rule number three, it needs to be unmitigated. Order blocks are a one-time deal, so we are only on the lookout for trading opportunities when the price taps into an order block for the first time. No second chances here. Now let's take an example with the BTC 1 hour chart. Let's pinpoint those order blocks. We are focusing on areas with evident inefficiencies on the chart. Our plan is to mark the candles responsible for creating this inefficiency, but with the condition that they also trigger a break of structure or a change of character. Following our rules, all these marked areas are considered valid order blocks. According to the experience gathered from the repetitive experiments, we have realized that when certain conditions accompany order blocks, the chance of winning the trade significantly improves. We also noticed repetitive patterns form on the chart that dramatically increases trading returns. So let me explain to you what conditions are required to identify a high quality order block. Let's break down the key factors to consider when trading order blocks. We have summarized it into four categories: market structures, volume, market trends, and recent order blocks confirmation in lower time frames. First, let's dive into the market structure. Understanding the market structure is crucial. It involves analyzing how price moves, identifying highs and lows, and recognizing patterns that help you make sense of the overall market dynamics. So, when trading the order blocks, keeping a keen eye on the market structure is a fundamental step. Now, let's take a closer look at some of the typical market structures patterns that unfold regularly. Here is an example. We have identified a valid order block presenting a potential opportunity to go long. However, if we shift our focus and we notice a gap between the candles right beneath the first order block, plus there is another valid order block zone in this area. It's these observations that can guide us to in identifying potential trading opportunities. So let's connect the dots here. With the presence of a gap and another valid order block just below the first one, there is a significant likelihood for the price to revisit and fill the gap. This move can involve grabbing liquidity below the initial order block and then pushing upward upon tapping into the second order block. So when this specific pattern emerges, as we have identified a gap with an additional valid order block beneath the first one, we assign the first order block less priority for trading considerations. It is crucial to note that breaking below the first order block doesn't necessarily signify a reversal. There is a substantial chance that this break is merely a liquidity grab, setting the stage for future market movements. The second key factor in trading order blocks is market volume. It's a noteworthy observation that winning trades often coincide with high volume sessions. The effectiveness of order blocks tends to be at its peak when there is a significant trading volume in the market. So, keeping an eye on volume levels is crucial when evaluating and executing trades involving order blocks. High volumes often align with successful outcomes in this context. Let's move to the third factor that significantly influences the success of order blocks: the market trend and their freshness. Order blocks tend to achieve higher success rates in trending markets compared to consolidation phase. Therefore, it is advisable to focus on trending order blocks. The fourth crucial factor to consider when trading order blocks is confirmation in the lower time frames. These confirmation act as a safeguard, preventing unnecessary losses when the market chooses to overlook the order blocks. Integrating solid entry reasons as confirmations into our trading strategy not only adds a layer of protection but also enhances our confidence in executing trades. In a sense, relying on confirmation in lower time frames serve as a valuable tool to validate the viability of order blocks and provide a more robust foundation for making trading decisions. Let's explore the approach further. While the order block strategy isn't confined to specific time frames, it is common to spot the order blocks on higher time frames and then zoom into lower time frames for confirmation and entry points. For instance, if using 4 hours, 1 hour, or 15 minutes as a higher time frames, the corresponding lower time frames for entry reasons would be 15 minutes, 5 minutes, and 1 minute respectively. Now let's discuss a common pattern used for placing orders. The first pattern involves a change of character move that creates inefficiency and a valid order block. To capitalize on this, the order is placed a spread size above the order block with the stop loss set a few points above the higher point of the zone. A simple technique is employed for taking profits, aiming for substantial risk to reward ratios. If the trade goes in the right direction and the price starts moving upward, the stop loss is continually repositioned under the market structure every time a new higher low is formed. This approach allows traders to take profit until reaching a higher time frame supply zone, at which point the trade is closed. It is a methodological way to manage trades and maximize profits while considering higher time frames dynamics. It is crucial to highlight that these trading setups are versatile and can be applied across various time frames and currency pairs. However, it is highly recommended to conduct thorough backtesting to determine which pairs are most suitable for these strategies based on historical performances. If you found value in this video, do not forget to give it a thumbs up to show your support. For those new to the channel, consider subscribing, and we regularly share valuable insights into trading strategies and concepts. And of course, if you have any questions, feel free to drop them in the comments. We make it a priority to respond to all queries. Thanks for tuning in, and we look forward to seeing you in the next video.